Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Bond Duration, a key measure in investment strategy. Factors influencing bond duration. Understanding what affects bond duration is crucial for investors. Bond duration shows how sensitive a bond's price is to interest rate changes. Several key factors impact this calculation: coupon rates, yield to maturity, and time to maturity. Coupon rates. Coupon rates are like the interest you earn on a bond. Think of it as a regular paycheck from the bond. Higher coupon rates mean you get more money in those regular paychecks. This makes the bond less sensitive to interest rate changes. So, bonds with higher coupon rates have shorter durations. Higher coupon rates. When a bond pays you more regularly, you're getting your money back faster. This shortens its duration. If rates rise, you already got more of your money back, so the price doesn't drop as much. Lower coupon rates. With lower coupon rates, you get smaller paychecks. Your money is tied up in the bond longer. This makes it more sensitive to interest rate changes. So, bonds with lower coupon rates have longer durations. Yield to maturity. Yield to maturity, YTM, is the total return you expect to earn if you hold the bond until it matures. It's like calculating what your total paycheck will be at the end of a contract. High YTM. Higher YTM means you are getting your returns quicker. This decreases the bond's sensitivity to interest rate changes and shortens its duration. Low YTM. Lower YTM means it takes longer to get your returns. This increases the bond's sensitivity to interest rate changes and lengthens its duration. Time to maturity. Time to maturity is how long until the bond pays back its face value. It's like the length of a loan. The longer the bond has until maturity, the more sensitive it is to interest rate changes. Short time to maturity. Bonds that mature soon pay back the principal faster. They are less sensitive to interest rate changes and have shorter durations. Long time to maturity. Bonds that take longer to mature keep your money tied up longer. They are more sensitive to interest rate changes and have longer durations. Understanding these factors can help you make better investment choices. Bonds with different coupon rates, yield to maturity, and time to maturity can behave very differently when interest rates change. Always consider these elements when selecting bonds for your portfolio. Practical applications of duration. Bond duration is a powerful tool that investors can wield for various strategic purposes. Let's explore 2 key practical applications: hedging interest rate risk and strategic asset allocation. Hedging interest rate risk. Interest rate changes can significantly impact bond prices. Investors use duration to manage this risk. By understanding the duration of bonds, one can anticipate how much the price of a bond will change with interest rate movements. For example, consider an investor holding a bond portfolio with a duration of 5 years. If interest rates rise by 1%, the portfolio's value is expected to drop by approximately 5%. Knowing this, the investor can take steps to hedge against this risk. Here are some strategies. Shortening duration. Shorten the portfolio's average duration by shifting investments to shorter-term bonds, which are less sensitive to interest rate changes. Using interest rate swaps. Enter into an interest rate swap where the investor pays a fixed rate and receives a variable rate. This can offset the impact of rising interest rates on the portfolio. Buying bonds with different durations. Diversify by purchasing bonds with various durations. This reduces the overall sensitivity to interest rate changes. These actions help protect the portfolio from the adverse effects of interest rate hikes, ensuring a more stable return. Strategic asset allocation. Duration is not just for managing risk, it's also a crucial element in broader asset allocation strategies. By integrating duration, investors can align their bond investments with their overall financial goals and risk tolerance. Balancing risk and return. Longer duration bonds generally offer higher returns but come with greater risk. Shorter duration bonds are safer but might yield lower returns. Investors can balance their portfolio by mixing different durations to match their risk appetite. Matching investment horizons. Young investors with a longer investment horizon may prefer longer duration bonds to maximize returns over time. In contrast, retirees might favor shorter duration bonds to protect their capital. Market views. Investors who expect interest rates to drop might increase their portfolio's duration to benefit from potential bond price increases. Conversely, those anticipating rate hikes might reduce duration. Understanding and applying duration helps investors make informed decisions, optimizing their portfolios to meet long-term objectives. Whether it's hedging interest rate risk or enhancing asset allocation, duration is a vital tool in the investor's toolkit. Common misconceptions about bond duration. When it comes to investing in bonds, many people get confused. It's easy to mix up terms or misunderstand what they mean. Two big areas where confusion often happens are bond duration and risk. Duration versus maturity. Clarify the difference between bond duration and bond maturity. At first glance, bond duration and bond maturity might seem like the same thing. But they aren't. Bond maturity is when the bond will be fully paid back. If you buy a 10-year bond, its maturity is 10 years. Simple, right? Duration, on the other hand, is a bit more complicated. It's a measure of how long it takes for an investor to be repaid. But instead of looking at the final repayment date, duration calculates the average time to collect all the payments. This includes interest payments and the final principal repayment. Because of this, duration is often shorter than maturity. Here's a quick way to think about it. Maturity, the countdown until the very last payment. Duration, the average waiting time for all payments combined. Understanding this difference is crucial. When you know both, you can make better decisions about which bonds fit your goals. Duration as a measure of risk. Discuss why duration should not be viewed as a complete risk measure. Many investors think duration is a complete risk measure for bonds. While it does give important information, it shouldn't be viewed as the whole picture. Duration shows how sensitive a bond's price is to interest rate changes. If interest rates go up, bond prices fall, and the longer the duration, the bigger the fall. However, relying only on duration to measure risk is like judging a book by its cover. There are many factors that influence bond risk, such as credit risk, the chance that the bond issuer can't make payments. Inflation risk, the risk that inflation will reduce the bond's purchasing power. Market risk, the risk of bond prices changing due to market conditions. While duration helps understand how bond prices react to interest rates, it doesn't cover these other risks. For instance, a bond with a long duration might appear risky if interest rates rise. But if the issuer has strong credit or the economy is stable, it might still be a good investment. In summary, be careful not to over-rely on duration. It's like using a single tool to fix all problems. Knowing the full range of risks helps paint a clearer picture and leads to smarter investment choices. Understanding bond duration is essential for any investor. It helps you gauge interest rate risk and manage your investments better. Knowing how bond prices react to rate changes can protect your portfolio. Stay informed and use duration to make smarter investment choices. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.